Hello, everyone. I hope everybody is good today and in a healthy mood. So, we'll start our lecturing. Before starting the lecturing, I want to give you some announcement about the quiz and assessment one. As we know, the next week is the last week before the break week. And so let me share the screen with you so that I can do everything, all the announcement based on the screen. So, we'll have quiz one and then we'll have assessment one. Okay, this we're planning to do it, and I'm planning to give you the quiz number one on when we have the class is on Monday. Okay, so I'm planning to give you on the 12th of October. So the quiz will be on 12th October. So it will be on 12th October, but not 60 minutes and not the 30 multiple choices. It will be
Sorry,
approximately.
Professor.
Yes.
It's the quiz number 2. It's not the first quiz.
Okay. Anyway, just a second. Thank you so much. So quiz number one, 5%. There will be 10 multiple choice questions and 25 minutes you'll be given. The chapters that you're responsible for is first two chapters. First two lectures that we covered, they're available in Moodle. You can follow the book as well. So one chapter from the risk management and the financial institutions from the John Howe, and the second lecture is coming from the CFA book. It's available in Moodle as well. Okay, first two lectures. What else concerning the date? Date is 12th of October, and the timing is during the class hour. And the important thing about this question, about this quiz and the assessment one, all the questions will be sequential order, which means that you cannot return to the previous question. So once you solve one question, you have to move to the next one. Will be in sequential order. You can use the calculator, you can use the Excel and everything, whatever you like. You can use it, will be open book, okay? But you cannot do the quiz in a team. This is one thing that you should keep in your mind. Displayed. Coming to the exam. Excuse me, Professor. I was late. May you please check me in attendance? I haven't taken yet attendance. I'll take the attendance in the middle of the class.
Oh, okay. Thank you.
What do you mean, Begzat, by giving some problems to prepare for? examples. All the activities you solve it, they are responsible for. This will help you actually, all the activities we do. So chapter that you're responsible, all questions are in sequential order. And regarding the timing, 60 minutes, I'm not sure about the type of the question, but I will try my best. Most probably it will be open and end questions, not the multiple choice. Maybe I will add some multiple choices. Maybe I will make the mix, like some multiple choice and some open end questions. So the timing is not, and the types of question, so it can be mixed. So you have, let's say, 120 minutes for multiple choice and open ended questions. And please use the timing efficiently. Regarding this statement, you'll get more details updated. Please check up this. Exactly what type of question. So it will be mixed, multiple choice and open-end questions, like the calculation that we have it.
Sorry, Professor.
Yes, please.
Do we need to enter Zoom during quiz and exam?
In the quiz, no need, but during the assessment one, yes. During the assessment one, yes.
Okay.
You have to enter and you have to share the screen. I mean the video of yourself, not the screen.
Okay, thank you.
And the date, I didn't put it. Let me just put the date. And concerning the dates and time is the same as the class hour, but it will be on 14th of October. Okay, the exam assessment one will be on the 14th of October. Date. Class hour. Begzat, no, for the corporate finance, I'm not actually. I have decided not to give you the assessment one now because I have to finish it. We're a little bit back in the corporate finance. We have to finish more. I will talk about the corporate finance later. Okay, so far so good. Quiz one and exam one. Now I can take the attendance and we can start. Adilet Rahmanov.
I'm here.
Here, okay. Tengir here. Aynur.
Here.
Raushan.
I'm here.
Bernard.
Here.
Mamet. Something happened to Mamet. He's not available these days. Okay, I have to check with him. Bekjan.
I'm here.
Sanjar.
Here.
Alua.
Here.
Dongo.
Here.
Aidana.
I'm here.
Almat. Erach.
Here.
Ademi.
Here.
Bekzat.
Here.
Camila.
Here.
Daulet. Ruslan.
Present.
Julduz,
Here.
Marjan. Marjan not here. Okay. And one more thing that I want to tell you before I just proceed to the lecture. On Saturday, 11 o'clock, using the same link. I don't know whether I told you or not, but let me tell you again. If I told you already, there will be a seminar which is going to be delivered by head of the financial advisory division in investment bank, Tengri Partners, and it is the only investment bank in Kazakhstan. Okay, so you have an opportunity to visit to see what this investment bank does in the Kazakhstan, and they're gonna give this seminar. So I organize this seminar every 2 weeks. Okay, every 2 weeks he's going to deliver some topics related to specifically to corporate finance and the risk management. And most probably it's going to be held on Saturday at 11 a.m. in the morning. So you are welcome to attend it, and because you're gonna get some really good benefit on that. At least you will have some idea what's going on in the real market, in the financial market, more clearly speaking. Okay. The last time we talked about was different investment criteria using like different interest rates, and even I gave you some activities to solve it. We can go over this activity, but if you have a time, but I want to proceed. So mainly we talked that the invest NPV is calculated using the present value of the future cash flows. And at the end, you just take in the subtraction of investment cost. In all courses and all finance courses that you have it, what we used to do is having just simple or single discount rate, which is not right because the discount rate is always changing from 1 year to another year. So we need to take into consideration different types of discount rates, and that need to be considered while estimation of the NPV. So this is the way we calculate, and for your revision, if you want to discount it, you should take this to the back, like passing from year 1 to the year 0. So from year 0 to the year 1, there's 18%, and from 1 year to the second year, 16, 14 to from 2 to 3, and 12 from 3 to 4. So if you want to pass the fourth cash flow to the year 0, that means that you need to take into consideration 1, 2, 3, 4 discount rates, 4 different discount rates. You should take into consideration 4 different discount rates. That will help you to get the more appropriate present value of the future cash flow. Or if you do the compounding should take the place. If you take in 1,000 to the year 4, that means that 1,000 will consider 1, 2, 3, 4 different discount rate, but it will be not discount for the 1,000. It will be more like compounding effect. So coming to the interpretation and decision based on the NPV. So
Professor, can I ask a question?
Please.
Could you please return to the previous slide?
Yeah. Yes.
Why we divide 200 by 18 rather than by 16?
Because 16% starts from the year 1. Okay. It starts from the year 1. It goes to the year 2, and 200 starts in year 2 here, but it's not considered here. But this one, it's from here to here. Okay. We're considering like this, from year 0 to year 1. So it was 18 here. From year 1 to 2, it was 16. This 200, if you take it here, then you should consider 18. But if you take 200 to here, if you compound it, then you should consider 16%.
Okay, thanks. It's clear.
Okay. So the decision and interpretation of the NPV, project returns are greater than the costs. This is like a simple definition of the NPV, that all the future benefit that you get it is more than today's cost or some future cost, benefit minus cost, and it should be discounted. So if it's more than 0, which is more than cost, you accept the project. If project earnings or returns and the costs are equal, you're kind of in an indifferent position. You're in a break-even point. So they're equal. And we know that there's one rate that makes the NPV equal to 0. What was that rate is called? Anyone who remember?
IRR.
Yes, very good. Internal rate of return. And project does not generate enough money to cover its costs when it's less than 0. In this case, we reject the NPV. This is things that you already know, and you already know how to calculate. So NPV is used as a decision criteria to answer the following question: when to accept or reject the project, how to choose the projects under budget constraint, and how to choose the project from the mutually exclusive alternatives. So when accept to reject the project, so you do not accept any project unless it generates a positive NPV. So when discounted by the opportunity cost of funds. So we're given different 4 different projects, A, B, C, D, and they have got some NPVs. Okay, they calculated the NPVs are 70 minus 50 plus 100 and minus 25. So only A and C will be accepted. The country is made worse off if the project B and D are undertaken actually. So how to choose the certain project under the budget constraint? Let's say you're given $4 million as a budget constraint, and still you have projects like A, B, C, D with a present value of cost, which is mean that with a certain budget you need to start this project from 1, 3, 2, 2, 2. So what it means in here, you can just combine the project, but the idea is that you should select the highest NPV. You can combine this and this, okay? Or you can combine C and D. Actually, you can combine A and C. You can combine an A and D. However, you will end up with some money remaining in your company, but which is not really good, because the money, when it stays for nothing, when it's not utilized, that really is a big issue for the company. So being as a financial manager, you should be able to utilize the money that you have utilize in a proper manner. But sometimes you might overuse the money. Like sometimes for the manager, it seems that, okay, if I have money in my company, it means that I should do everything to make this money to use. But it's not really good. You have to find really good opportunities in order to use this money to get the best benefit that you could have ever achieved actually. So a combination of B and C and BD are not feasible as they cost too much. But if you combine the project A and C, and A and D are within the budget, but are dominated by the combination A and B, which has the total of NPV 460, and the CD is also possible, but NPV is not much as A and B. And how to choose the project from the mutually exclusive alternative. So in a situation where there is no budget constraint, but the project must be from the mutually exclusive alternatives, we should always choose alternative generates the largest NPV. So assume that we must take a choice between the following 3 mutually exclusive with a positive NPVs, and we will choose only the largest one. We cannot choose 2, we cannot choose 3. It's a mutually exclusive that we can choose only one project. So project F should be chosen because it has got the largest NPV, although the project G has the highest NPV per dollar of the investment. Okay, coming to the IRR, which the rate that you know already. IRR is the discount rate at which the present value of the benefits are just equalized to the present value of the cost. So NPV is equal to the 0. And the fundamental assumption of the IRR is that throughout the project's life, the opportunity exists to invest in any surpluses at the rate of IRR per year, and all costs that are financed at a cost of IRR per year, they're all equal. So IRR makes the NPV equal to 0. IRR shows the point where the NPV is equalized to zero, which means that you are at a break-even point where your all future benefits equal to all your costs. So you're not making any money and you're not losing anything. So whatever you have invested, you just recovered. This is all about the IRR. And for the IRR case, in order to select certain IRR, one thing you may compare with is the cost of capital. If the IRR is greater than the cost of capital, then it just says that the project is acceptable and you should go with certain project. So IRR criterion has considerable use both private and the public sector, as the way described the attractiveness of the project. The common interpretation, if IRR larger than the cost of fund or cost of capital, as we say, then the project should be accepted. If the IRR is equal to the cost of fund, then the investor expected to recover their expected capital and earn rate of return equal to the IRR. So IRR is less than cost of fund, then the project should not be taken into consideration actually. However, there's one issue related to IRR. IRR is not reliable investment criterion as NPV, as the not only the NPV, but there's other investment criteria. But if you compare with the NPV, mainly they're being compared with IRR with NPV. So NPV is the best investment criteria. Even though the IRR has got some pitfalls, the people still are really still using the IRR investment criteria because of its easiness of interpretation and easy of the way of calculation. So the main advantages of IRR is easy to communicate and solely relying on the information from the project. So drawbacks of the IRR may not be unique. So in a certain project, when there's irregular cash flows, the cash flow can be negative or so on. You may have more than one IRR. IRR cannot handle mutually exclusive projects of a different scale. So if the scale are different, the IRR will be different. So that is really making the IRR out of the order, out of the service, we can say it more simply. So it doesn't give you the really proper information about the choosing the right project when there is a mutually exclusive condition exists. And it cannot handle mutually exclusive project with the different length of the life. So different length of lives of the projects, the IRR cannot be used. It cannot handle mutual exclusive project with a different starting point. So the project can start differently. One project can start today, the other project can start 2 years from now and may end up with the same years. And however, the IRR cannot be really reliable in this point as well. And as I said, that the IRR cannot handle the irregular cash flows. So these are the disadvantages of the IRR. That makes the IRR to be kind of not reliable as much as NPV. So the IRR is the root of the mathematical equation, which is based on the time of profile and incremental of net cash flows. If the time profile crosses the horizontal axis more than once, that means there are more than one negative cash flow that it passes here. This is horizontal axis timing. So that means there will be more than one IRR. So it's kind of not possible to determine a unique IRR. So the IRR will only have the unique value if the negative cash flows are all in consecutive years. IRR and the risk analysis. If a risk analysis is carried out for a certain project with a life of more than 2 or 3 years, there will be almost always be scenarios where there is one or more negative cash flows in future years. So this will generate kind of not legitimate IRR. Like we are given 2 different projects with a case of mutually exclusive projects. As you can see, the project A should be selected. So how do we choose when there are two IRRs given for two different projects, you choose the highest IRR, and choosing project A according to IRR and choosing project B according to MPV. So what should be your decision? Your decision should be based on the MPV. MPV is the best investment criteria, is the best reliable, the most reliable investment criteria if it is compared to other investment criteria, specifically to IRR. IRR is not reliable as much as the MPV. So as you can see in the mutual exclusive case, IRR fails to give information about the decision which project should be selected. Mutual exclusive project with a different length of life. As you can see, the IRR take you away from the right decision. It gives you really not clear IRR. Still, the IRR mislead you here. It tells you to select project A, even though the project B gives you higher MPV. However, to compare the MPVs in here, it would not be really nice, because if you have taken any corporate finance courses, if there is a length of time of the project with different MPV, it's not good to compare. So you have to make something with this. Does anyone remember, whoever has taken any corporate finance from me or from any other courses? What should be done in order to compare the MPV as well in here from the corporate finance courses?
There are two methods. One common annual equity EAA method. So
Okay.
least common multiple and equivalent annuity something.
Yes, equal annuity method. That's very true. Least common multiple lives methods. That's very true. I'm very happy that you really remember this. So these two methods are used to make easy to compare, to make most valid way of comparison of the MPVs if they have got two different project with a different lives. Okay. So in this way, the MPVs can be used to compare, but still the IRR cannot be used to compare. Still the IRR will give you the wrong decision. Mutual exclusive projects that are starting at the different points in time. Okay, one project starting today, the other one starting 5 years from now. And as you can see, the IRR is different. And according to MPV results is different. So according to the IRR, project B should be selected, but according to project A, the MPV should be, project A should be selected. So this is kind of misleading selection. We are given project A and B, 5 projects, okay, 5 different projects. As you can see, there are IRRs as well. So look at here, what kind of IRR? 10, -2, -16, 4, and so on. When there is irregular cash flow, actually, that really creates a big issue concerning the IRR, that which project should be selected then. If you calculate the MPV, you might be coming with a different scenarios actually. So continuation of the example from the given above. So we can see the project B is obviously better than the project A because the IRR is greater than B. Look, A is greater than B. IRR-B is greater than IRR-C, IRR-D is greater than IRR-C, and IRR-E is greater than IRR-D. So note that in order for project A to have the 0 MPV, the benefit from the year 0 to the year 3 have to be accumulated at higher rate of return. And in order to cover this 8,000. So of course, in year 4. So in the case of the project B, they were the negative cost. In year 4, only 6,400. So if you calculate the MPV in these projects, you will definitely come up with a different conclusion. So far we have been talking about the problems of the IRR. So it can be said that there are many scholars really attempt to kind of modify the IRR, to change it, to adjust it, to make it like clear out of errors. And they come up with a certain conclusion. The best way to do it is to proceed with the modified internal rate of return. So modified IRR is the financial measure of investment attractiveness. It is used in capital budgeting to rank the alternative investment of the equal size. As the name implies, the MIRR is the modification of IRR. As such, aims to resolve some problem, not all of it, okay, some of it. First, what they do, they discount all the negative cash flow to the beginning year of the project at the firm's cost of capital or country, and compounding all positive cash flow to the year end of the project firm's financing cost of capital or country something. Now we have initial cash outlays. Let's say the example given here. Okay. We discount negative cash flow to the beginning of the year, and we compound all positive cash flow to the end of the year. Okay. This is, and then at the end, to calculate the MIRR, compounded value divided by discounted value, and raised to the power 1 over the number of the years the project has it. So this is the way to calculate MIRR. So as you can see, 8,000 discounted by 1.12, the discount rate is 12% to the power of 4, and 1,000, 1,200, 800, and 3,600 compounded to the year 4. And their division, and we do not take this negative sign in here, okay? We do not take it. 8,000 divided by 5,000 raised to the power of 1 over 4 and minus 1. This will give you the percentage of modified internal rate of return.
Professor, where did we take the 12%?
It's given discount rate, cost of capital. It's the cost of capital. It's cost of capital. Or if you remember, if you've taken any corporate finance courses, it's the same as weighted average cost of capital. So the modified IRR provides an accurate ranking project with the irregular cash flows, and it can rank the project with the mix of more than one positive or negative cash flows over the life of the project. And when the costs do not come at the beginning of the project. So as you can see here, according to IRR, you would select project E and A. But if you calculate MIRR and according MPV, let me just select like this, make it. So according to MPV, let's go with MPV. Which project will you select according to MPV?
Project C.
Project C. Okay. According to IRR, which project we will select? IRR.
Project E.
Project E. And according to modified internal rate of return, which project we will select?
C.
C. So now we can really say that MIRR and MPV, more or less, they go in the same direction. They go in the same direction. They select project C. But internal rate of return shows that project C is the worst project. The worst among the 5 projects. So modified internal rate of return is like an IRR that does not give a reliable ranking project in the case of mutually exclusive project of different timing, mutually exclusive project of different length of life, and different scale. If timing and the scale and the length of the life is the same for the project, then there is no problem with MIRR. That's okay, you can use it. However, if there is some issue related to that, then it really creates a big problem for that. You cannot really rely on that. So benefit cost ratio, sometimes referred as a profitability index, is the ratio that shows the present value of the future cash inflows, or we sometimes call it a benefits, divided to the present value of the cash outflows using the opportunity cost of funds as a discount rate. So according to the benefit cost ratio analysis criterion, in order for the project to be accepted, BCR should be more than 1. So for every dollar you spend, how much money you generate. In order to be acceptable or profitable, it should be more than 1. For choices between mutually exclusive project, you should choose alternatives with the highest benefit cost ratio. So there's some challenges with the benefit cost ratio. Being a ratio, benefit cost ratio cannot reflect the size of the project, and that ignores the scale of the project is the first one. And the numerator as a benefit and denominator as the cost can be defined differently when it comes to operating costs. So benefit cost ratio may cause incorrect investment decision if mutually exclusive projects have different sizes. Example given here. Consider the following cases with the mutually exclusive condition. Like present value investment cost is 1 million. Present value of benefits 1.3 million. And net present value of benefits is 0.3 million. So project B, project C, you can see it here. Benefit cost ratio, the highest one is at project C. But as you can see, the highest MPV is at project B. However, it is the lowest benefit cost ratio. Why? Because the investment cost is large in here. The scale is big. The scale, the size is very big. That's why it makes the ratio smaller. So that may kind of mislead you as well. So as a conclusion, the MPV is the best investment criteria in contrast to other investment criteria. So benefit cost ratio is sensitive to the way in which the cost is defined, setting out the cash flows, like gross benefit, operating cost, and capital cost. So operational cost in the numerator and operational cost in denominator. How it's calculated in here. So gross benefit minus operating cost divided by the capital cost. Or you compare with the same thing, do the project B for this. Project B, in the same way of calculation, the same way of definition, you can see that project B is like denominating it. The project B is higher. However, if you define the benefit cost ratio in a way that operating cost in the denominator, then really benefit cost ratio analysis for project A is overcoming the project B. So it is matter of definition of the project itself, okay, how the cost is defined actually. So this will affect as well the decision or based on the MPV or on the benefit cost ratio analysis. So that's why it's not reliable as much as the MPV. So payback periods, everybody is familiar with this. It shows how much time and how it measures the number of the years it requires to get paid all the costs that you already spent or in certain project. However, the problem of the payback period that it ignores the benefits beyond the payback period. The financial institution may use the payback period as a proxy for debt service coverage ratio. How useful when the project is subject to high levels of the future. And payout period have two serious issues. Assume that all benefits that are produced by longer life of the project have unexpected value of zero after the payout period, or it also ignores the investment cost that might occur beyond the payout period. So these are the main issues about the payback period. So that's why still I can underline one more time that the NPV can be considered as the best investment criteria. And here's an example given graphically that this is the timing that the project A is denominating the project B in terms of faster, that is quickly covering the investment cost. So if you have any questions, I will be glad to answer. If you don't have any questions, I want to give you an example so that you can just practice it and kind of make the activity. Activity number 6. You have any questions? Okay, that seems you don't have any questions. Okay. We have project A and project B. Or you know the best thing what I can do? I can just duplicate the activity 5 and ask you, because I want you to solve it benefit cost ratio and to solve the modified internal return and IRR there. Okay, these are the activities. So this will be activity 6. Okay. You already calculate benefit cost ratio. Calculate IRR and MIRR for this. And changing signs, let's say okay, leave it like this. Let's be in this way. So calculate benefit cost ratio, calculate IRR, and calculate modified IRR. I'm saving it. The timing I'm putting today, 7, 7. So from 18 to, you've got more than enough time. So until 7:30, it's available, any type, okay. So activity 6 now in the Moodle. Please start doing it now. I'm done for today. You're responsible for the first 2 lectures. This chapter 1 introduction and alternative investment. So whatever we've seen here, you will not be responsible for something beyond the schedule. Exactly whatever you solved in the classes in all activities that we have it, you're responsible for that only. This first 2. But coming to final exam, sorry, the exam 1, assessment 1, you're responsible for 1, 2, and 3 chapters. If you don't have any questions, you can start doing the activity.